All right. Good morning, everybody. The day we've been waiting for. We have another big day on Friday, too. So just remember to keep that in mind. Non-farm payrolls is no joke. It's a big one. The QRA should be early this morning, around 8:30, I believe. You're not going to find it on any of the sites that you would normally look at. Like Trading Views got an economic schedule. It won't be there. Thinkorswim has one. It's not going to be there. Same thing here. U.S. economic calendar on Market Watch. It's not going to be in any of these places. Um, that's one of the feedback that I got from people on Monday when they said, "What was that big move at 3 o'clock?" It's QRA. Well, it didn't matter that we'd been talking about it for a month, that been discussing it, warning people about it. Some people don't listen to us, right? They just kind of kick back and do their own thing. And they assumed that if they're looking at the economic events from these different websites, then they're fully aware of everything coming at them. But QRA does not show up here. So you kind of just have to know about it. And then once you do, I mean, I don't think anybody's ever going to forget it once you learn this one. It's kind of a big one. So QRA happens 4 times a year. It's always around the same time frame, like May 1, November 1, August 1, February 1. You kind of get the idea. And the date may be off by a little bit, but it'll generally tie in with an FOMC too. So, you know, um, kind of take it with a grain of salt. All right. So what we have right now is a couple of markets closed. There's Asian markets closed and some European markets closed. That's likely going to affect the volume a little bit, but on the other side of that, the volume would already have been affected anyways because we're all in this hurry up and wait mode. Something to consider as well. The NASDAQ is down the most, more than 0.5%. The Russell right behind that at 0.5, then the S&P less, and the Dow almost flat, with the UK flat but up on the positive side of. We're going to get some employment numbers today. It's only some of the employment numbers. It's not all of them. It's not the big ones. Non-farm payroll is the biggest one that you want to pay attention to, and that's on Friday. Taking a look at FX Street, you can see we've got high impact events all day and in the overnight hours. So, it's one of the things that I like about FX Street and Finance Juice is they do point out what's going on around the world. And it might seem like a very obvious thing, but I can tell you when I was new, I didn't think about other countries having employment numbers and Fed meetings, and it just never crossed my mind. I don't know why. It just didn't really occur to me that we should be concerned about Canadian unemployment numbers or, the central banks in Europe. So using a website like FX Street, Finance Juice brings that to your attention. That way it's not easily overlooked and gives you the impact rating. Since there's so many different economic events, it's sometimes hard to tell which ones are likely to be impactful or important and which ones maybe that don't hold so much weight. We're going to get data out of Japan. This continues to be a very big brick in the wall of worry. But as I've mentioned recently and continue to mention, if you're looking at US dollar China and seeing it sitting up there in that nosebleed area, yeah, that's concerning, but it's already there. If it was a particular dollar value on the US dollar Japan chart that we could point to and say they'll intervene at this point, then that would be great. But it's not on this chart. So go to the 10-year for Japan and keep your eye on this one instead. 1.0 is the level that we really want to be aware of. If it gets too close to 1.0, they're very likely going to intervene. That's what you want to watch for. Just the other day, we had intervention, and it was after we had popped out of this zone and made a move above that 0.92% or 0.90%. So you can see if we get above that level, that's really where the concern starts kicking in. It's not a perfect system. They will lie just straight out. They'll say, no, we didn't intervene. It's happened before. It'll happen again. You know, they don't always lie, but they certainly don't always tell the truth. So if they're going to intervene, they're not likely to give any clues first. They're not going to put out any warnings or anything. And it's odd that they intervened in the first place on their own, that they didn't have the backing like they did the last time. It wasn't a coordinated effort. But with everything going on and with the FOMC meetings coming up, and remember, it's not just ours, it's all over the world. Then the idea that they could intervene with some assistance is still on the table. So watching Japan through US dollar Japan is always insightful. It gives us some ideas of what's going on in the market, but keep your eye on the 10-year, the Bank of Japan 10-year, right? That's the one you want to keep track of. It's going to be a hurry up and wait day. On the one side, that very likely means that we're just going to chop sideways, not really do much. But as I've mentioned before, the lack of liquidity can cause market movement. That's often overlooked by newer traders, thinking lower volume means lack of movement. But lower volume means that we can move it easier, that it doesn't take as big of an order to move things. And if you ever want to kind of see that in action, look at the NQ in the futures versus the ES in the futures. That's the NASDAQ versus the S&P. The NQ is very thin, and it doesn't take very much to see that thing just gapping and jumping all over the place, as opposed to the ES, which is thicker, where each tick generally has 50 to 100 contracts per tick, and it's just so much thicker, it takes more work to move that thing. So thinner markets can move faster, they can move farther. We can see that they're hedging this morning. This isn't my opinion. I don't have to assume that they're hedging. It's not my beliefs that they're hedging. This is fact, right? Like the sun comes up, that if you jump in the air, you're coming back down. It's fact. They're hedging. We can see it. It's the market maker move. The volume is actually not as light as it was yesterday, which is a little bit of a surprise if you think about Europe closed, some of the Asian markets closed, and we still have this level of volume. That's impressive. Add to that we also have hedging today. Generally, it's one or the other. They'll hedge without trading, or they'll trading without hedging. So we've got a lot going on in this market, even on the idea that we should be sitting still. We should be waiting on FOMC, and that's not what we have at this point. So it's always good to back test, to have some historical precedent. What does price generally do? Blah, blah, blah. Always. It's a really good idea. But then you have to be able to recognize when things are not doing what they generally have done in the past. High volume with hedging on a day where we should be sideways, especially with multiple nations closed, we're getting some flows. So don't expect the sideways waiting on FOMC to kick in just yet. It could happen later in the day, say after 11 o'clock. We might start tightening that range. And it wouldn't be the first time we've seen that before either, where the market makes some reasonably good moves through the morning session on an FOMC day, and then finally starts going sideways around 11, 11:30, maybe even around noon. So something to keep in mind. This market maker move is not on all platforms. It was a concept developed by the Thinkorswim creators, Tom Sosnoff and Don Kaufman, those guys, right? When they were putting all of this together. We can see it on Thinkorswim right here. But if you're not on Thinkorswim, you don't have that. It comes from looking at the front end, which happens to be this series here. This one is gone. This is today's. We can just look straight across at the implied volatility average. It's higher than the next series out, and that means we have a market maker move. If this didn't say 20.4, but instead said, I don't know, 18.4, then we wouldn't have a market maker move. It would be lower than the next series out, and we wouldn't have it. But it is higher. That gives us a market maker move. And that straight up tells us that they're hedging. Why? Well, it's implied volatility average. If we were talking about implied volatility on a stock chart, then we would understand explicitly what that's telling us. Implied volatility is measuring candle close to candle close. So how much did price move? But this is implied volatility on an options chain. We don't have candles with candle close to candle close. So where are they getting this implied volatility from? Well, each strike has its own implied volatility. This implied volatility changes by the pace and the speed that these options are being traded. So if one series like the 49.50 strike starts getting traded over and over and over very fast, then it will change the implied volatility on just that strike. And then of course it'll start to bleed out into other strikes. If we look at the volume today, we've got 1,600 here, 3,000 there. So a few of these out of the money options have a higher volume than the other ones. And that is where the implied volatility in the out of the money contract starts to change. All of this matters because these numbers here are derived by the out of the money options. It's an implied volatility average of this series. So if they're hedging, meaning they go out of the money and they start trading a bunch of out of the money contracts, it impacts the implied volatility average and jacks it up higher than the next series out. That action shows us that they're hedging. And if you want to know more about that, they write quite a bit of it on a website created by Thinkorswim. It's called the Ticker Tape. You can just go to Google, type in TD Ameritrade Ticker Tape, and you'll find that website. Once you're on the website, just search Market Maker Move. They've got 30 or 40 really great articles that they've wrote over the years. None of those articles talk about futures. I don't know why. They were just more interested in focusing on market maker moves from earnings and events like new drug trials, things like that. And that's really why it was developed. But once you know what the tool is for, you use it however you want. And I applied it to futures. It works perfectly. So if you're wondering where to learn more about it, that's where you can do it. I mention that because I've heard, I'm not going to name some names here, but I've heard some really big name people get this completely wrong, right? I'm not going to say that it was John Bollinger or, you know, the guy that created Keltner's or the guy that created the MACD, but it would be those kind of people, that kind of name recognition people who try to talk about market maker move and get it all wrong. So don't get it all wrong. Go learn from the source. This is a Thinkorswim tool. Learn about it from Thinkorswim. We're under the VWAP inside day breakout. We have a market maker move. We're ready to go. We've got everything that we need for a reasonably decent trading day. We're still inside the ADR lines on both sides. We have a missed daily pivot. We haven't hit the daily pivot at all. We're underneath the weekly pivot. And we now have the answer to a question, at least on the weekly, on whether or not this was going to be a pullback. Like yesterday, we were discussing You know, until this pulled back, let's just get to that point right there. Until we got a pullback, we didn't know if this was going to be a lower high. It's not hard to assume that it was going to be a lower high, but we just didn't know. It could have just run right back up again, never falling down, and that would have given us an equal high if it had just kept running. But now we had that, and then we have this. So we now have that lower high. It's confirmed. This still is just a complex topping pattern. We still have to break this low. Until we do that, then it's not a confirmed bearish pattern. It's just an uptrend that is no longer in an uptrend. So it's paused, damaged, broken, put all kinds of words in there. But the downtrend isn't confirmed until we break this low and start moving to the downside below that. Wicking below doesn't count, right? We need to close below. With the amount of economic material that we have this week, including Friday, that it's not just today, you got to keep that in mind. We could easily overtake what happened yesterday and continue this move to the upside. It's absolutely possible. We got tangled up in that 20 period moving average yesterday and closed below the 20 again, the 50, the 10. We're underneath everything on the daily. The only thing that's below us is this upward sloping 200-day moving average. Now, when it comes to the weekly chart, there is a little bit of an issue on the fact that we hadn't traveled up high enough to this for this to be considered another leg, right? The downward move is enough to consider it a leg down, but this move up does not count. We would have needed more. So we don't yet have our lower high on the weekly. We're also inside another week, and that inside week from back here is a very large week, so it's not like IX10 exciting. It's just a massive range, and we have to get out of that range. But it is tightening up, so we have the next range, and depending on the candle that we get this week, we might have yet again a tighter range, tighter, tighter. Eventually, something will break. I keep coming back to this point on the chart. Where we had a very large week and then an inside week. And for a lot of this week, it was the same thing. We were just inside week until we finally got out of it, broke that range. But it didn't work, and we came back in anyways. This, I continue to be drawn back to these three candles over and over again, looking at our current situation. We don't know how this is going to play out yet, but until we get out of this zone, then you can guess and assume all you want for the broader market, bigger picture, what we think the market's going to do. But until we get out of this range, you're just guessing. That's it. There's just nothing more to it. We do have the capacity to move a long way today. The market maker move is to be added to the yellow lines. The yellow lines is how far this market has moved on a day-to-day basis over the last month. So right now we've got a 21-day average daily range of about 1.44%, which is about 72 points higher or lower than where we open in Globex. Well, if you think about that, we could move half of 72 to the upside and half of 72 to the downside. And that would be 72 points between the two of them. But we could also just move 72 points in one single direction, all the way down or all the way up. It would still be 72 points, right? So the distance between these two red lines, that's 72 points. The distance between the Globex open and this high, that's 72 points. And or to this low, that would be 72 points. Kind of get the idea, right? Now add another 21 points to that. So 94 points total, and it still wouldn't be considered an outsized move. It'd just be another day at the office. We didn't move too far, too fast. It wouldn't owe us a reversal. It wouldn't even be considered extreme, that we could just make a 94-point move and it would just be another day. So one of the things that you can do to identify that level is just take your marker from the yellow line and run it up another 21.5 points. There's no reason to really nerd out on it and get it absolutely specific. Close is close enough. So we would have to go farther than that before we would start to consider today's moves beyond the norm. How much farther beyond the norm? Well, if you weren't trading around COVID, you might not have ever seen it before, but we can trigger lock limits in the S&P, or in the futures, not just in the S&P. Every market's got a lock limit to it, but those can be removed. They do get removed around 3:30 in the afternoon. And I don't think they make special arrangements for certain days where they don't remove the lock limits. So something to keep in mind. There's always that potential for something very nasty to happen. Imagine they turn off the lock limits at 3 and Powell wraps up, and then the market finally makes that last leg and just really crashes and burns. That'd be interesting to see. So either way, we just always add that market maker move to the ADR past the yellow lines. We do have the put wall underneath this, so if we do make moves to the downside, we're expecting that liquidity to be there. First touch is that we would bounce off of it the first time, right? Just because there's a lot of liquidity, it's hard to imagine that we're going to absorb it all in one shot. $10-day, 30-minute volume profile. We've gone nowhere fast, so we're just building up more and more liquidity. And we're going to get this spot gamma off of here. Kind of clean it up a little bit. It's still the classic D shape. We don't have anything of note here. And over the next few days, as long as we're still maintaining in this range, nothing's going to change. It's not like we're going to lose, the lower level or the upper level. We're losing candles right through the middle of all of this. It's not going to change where the point of control is at. 5x5, generally we would expect it to look like back here, very narrow, tightly compressed, getting ready for an event, or maybe back here, really narrow, tightly compressed, getting ready for an event. And yet we don't have that. We've got a nice wide profile, and it's actually a little bit of a V profile. Looking at yesterday too, we would have expected something more along the lines like this, where we had a move and we ended up with the volume and the point of control in the lower portion. Even just a more classic D shape with maybe the profile closer to the middle. And yet we don't have that. That big move down last night, there wasn't some big saving grace of volume down there like there was down here. They tried all that right around 5,100. Liquidity resides on the other side of the pivot. So we made it through the other side of the pivot. We got into that liquidity, a little bit of save a hoe. They tried to hold it up, tried to run it back. And when it didn't work, they dumped it. And there's really nothing here showing that they tried to save it after that. So far this morning, we can see the point of control in the lower end down here starting to finally pick up. But we're still just waiting. So I would not expect a hurry up and wait kind of day at this point until at least 11:30. We've had some examples in the past where we've cut down below the previous week and stalled, came back above it, below it, and was just really crisscrossing this zero line back and forth. We've done it before. It's not completely unheard of, but usually we get a nice deep move under the 10. We come back up and resolve it, and then we're back above it again. We don't want to spend too much time just chopping that 10-week up. Doesn't really resolve anything, but this is a really big event. We're working with the anchored VWAP for the year. We got to get above it. We're underneath that 10. We've got to get above that. And now that we've set this lower high, we got to resolve that. On the week, this is the weekly expected move. How far we expect the market to move within the whole week. We made it outside that box in 2 days. Now we're outside of it. We need to resolve this. Generally speaking, we close inside that box 70% of the time if we're using one standard deviation. So if this was anything other than the S&P, it'd be 7 out of 10. The S&P, though, is really accurate with its expected move and generally closes in the box 80% of the time. It's still only owed a 70%, just a one standard deviation. But that's how accurate the S&P generally is with its expected move. So on the one hand, we can look at this and say the numbers say we're more likely to close in this box at the end of the week than we are out of the box at the end of the week. But it's been getting it wrong quite a bit lately. It just shows that the market makers aren't getting that volume, that volatility priced into the numbers, right? All of these ranges are derived from these numbers. It's where the expected move comes from. So if the numbers aren't reflecting the volatility, then the width is too narrow, price breaks it. It's been getting it wrong a lot. Last week, we closed outside the box. The week before, almost the week before, we happened to run back up right at the end of the day and save that one. But 2 weeks beyond that, another week where we closed outside the box. So you kind of get the idea. It's been wrong a lot lately. That usually foreshadows a market that's about to get blindsided by data. It reminds me of pre-COVID through November and December and January when we started breaking out of the expected move a lot. And there was, a little bit of whispers that something was wrong. COVID was just really starting to expand. And then we had COVID. There's been other times too, Volmageddon. There's been numerous events where the implied volatility was foreshadowing a situation. So multiple weeks outside the box, it's just another brick in the wall of worry. Something's a little off, be a little cautious. And I'm not saying you have to get out of all your swing trades or anything like that. Just, it doesn't hurt to reduce your position size a little bit. Maybe take a little bit of profit, add a little bit of protection, add a hedge or something. We can't sit out over every single brick in the wall of worry, right? For the 10-day, we're 1% below. Throughout this year, we really haven't spent much time below the 10-day, but looking back over last year and the year before, we spent a considerable amount of time in there. And if you notice when we were underneath that 10, say right here for an example, it lined up with FOMC and QRA. Or right there for an example, it lined up with FOMC. And here when we came out from underneath the 10, it lined up with QRA. So, chicken and egg, cause and effect. Take it however you want to take it, but it's not a surprise that we're dealing with being underneath the 10 right when we're lining up with FOMC and QRA. There has been some hints, and I'm curious to see how this is going to play out. there's been some hints where Powell has been kind of chastised or blamed for igniting the animal spirits, so to speak. Got everybody all fired up back in December FOMC, and caused this, right? That he loosened policy just by implying all those cuts, right? Remember at the start of the year, they were looking at what, 6 cuts for 2024, and it really just lit the market up. There's been a couple of hints or whispers that he might try to overcorrect that a little bit. And if you guys remember during that bear market that we were in a few years back, we had this run up into the 200-day moving average. It was on watch. Everybody was watching for it. Like the entire world was all watching the S&P move up into this 200 period moving average. And we were watching Jackson Hole start to unfold, right? It was around that time frame for Jackson Hole. During Jackson Hole, Powell comes out and he has a 10-minute time allotment for a little bit of a speech. He didn't use the full 10 minutes. If I remember right, he didn't even use full 5 minutes. He came out with a mic drop moment talking about higher for longer, suck it up, this is going to take a while, and he dumped the market on its head. I bring it up from the point that when Powell wants to, he can get rid of that stumbling, bumbling, I'm an idiot government employee, and he can just smack this market down just fine. It was either this big candle or it was this big candle. And I'm more inclined to believe it was this one since it's still in August, and I'm pretty sure that was Jackson Hole. But that was Powell, either way, whichever one it was. The big old mic drop moment. So, when he's reading from the script, he tends to remain on track. It's after he's done reading scripts and he starts taking questions that he can deviate a little bit and sound a little dovish. So we'll see. That's kind of the only thing we have today. We already know that they're not supposed to be raising rates. They're not going to cut rates. They're just going to hold here. They're not changing the dot plot. They're not changing anything. So what else do we have to look forward to, whether or not he's going to bow up and grow a pair, or if he's just going to keep them in his purse? That's it. So for anything else with the equities today, what's up or what's not up, it's all going to get adjusted based on QRA and everything else. So anything that might be up or might be down could very likely just swap places. I wouldn't spend too much time trying to look at different ETFs this morning and things that are moving around, because they're all very likely going to be affected by QRA and then FOMC and all of the other data points that we have on the table today. Yeah, it was a mess. Most people didn't think he had it in him back on that Jackson Hole moment, but he got it done. There was a little bit of news on pot stocks. So late in the afternoon yesterday, we seen pot stocks take a move. And, they continue to say that there's still a lot more work that needs to be done when it comes to legalizing this and changing the narrative when it comes to pot stocks. But it's just one more step in that direction, right? So don't be looking at this thinking, oh, well, we're finally going to, run up and see pot stocks come to life. And no, there's still a ton of work to be done. But that was a pretty nice move on news. Oh, absolutely, there will be pain. So I just wouldn't dig too much into this today on what's up and what's down. Let the news come out. At least QRA this morning, right? Let that data come through, and on the other side of it, maybe try to find something that you can play through the day. There's things that took a pretty serious beat down, right, from earnings. So you can kind of go that route if you want to. those earnings plays very likely won't be affected by, any other news today. They're just going to move based on whatever the earnings event did to them anyways. So there is that route, but I wouldn't try to lean on, the Bitcoin proxies or China ADRs or pot stocks or any kind of theme like that. Not today. I'd wait for the data. And that's what I got. Everybody be careful, be safe. I'll see y'all tomorrow.